The Morgan Report with David Morgan.
David Morgan of themorganreport.com for the week ending 17 June 2022. Well, only a week ago, I did an update on inflation concerns worsen, and as that was a main theme, the CPI came out 8.6 from the previous inflation rate. A lot of people were expecting to go down, or some still held the false belief it was transitory or whatever. We'd already peaked. Well, that's not what happened a week ago. And then this week, I think it was Wednesday, the Fed came out and raised their interest rate by 75 basis points. So now their overnight rate is 1.5%. It's doubled. It used to be 0.75. Also, in their consensus meeting of where will rates be, I think it's a year from now, maybe two, I think it's a year. Consensus is right around 3, which means it will double from here. So as interest rates go up, stock markets go down, bond markets go down. And of course, we saw gold and silver come down, went up, and came back. They're holding fairly well at this juncture, and I expect that they will continue to do so. Nonetheless, everything's getting hit. And obviously, real estate is hurt as well, because as interest rates go higher, then the cost of borrowing or getting a mortgage, financing for a home also increases. And it's up to, I think, about 6.5% on a national average in the United States. I want to talk a little bit about energy on this week's perspective. Russia's move to cut gas to Europe via the Nord Stream 1 sent energy prices higher. And prices were driven further by Libya's political crisis that's now seen virtually all oil production and exports taken offline. New sanctions were slapped on Iran, adding to the mix, and I believe that's approximately 1 million barrels today, if memory serves. And this was largely ignored with the other commodities that, let's say, Russia has, which, of course, is really a weapon against the West, because the sanctions are probably hurting the Westerners more than it's hurting Russia itself. Regardless, the geopolitics are becoming more and more dicey at all times, and we're seeing many analysts talk about oil going above 140. I do believe that's the case, but not immediately. What we want to remember is that the top was about 3 months ago at $130.50 per barrel for WTI West Texas Intermediate. And on this latest rally, we topped out at about 124 a few days ago. And now it's fallen to about 112 or so as I'm doing this podcast. So with it not taking out the top on all of the concerns I just mentioned, it looks to me like we may see some cooling off in the oil price for a little while. How long, of course, remains to be determined. When the Fed raised their 75 basis points this week and promised more to come, the Bank of England and Swiss National Bank made it abundantly clear that they too were in line and would raise their interest rates. One thing that very few are aware of is that despite the European Union sanctions on Russian oil, crude exports from Russia are at the highest level they've been since May 2019, at approximately 3.88 million barrels per day so far. This is an almost 600,000 barrel per day increase against pre-war levels of exports, with China and India becoming the largest buyers of Russian crude, with the respective shares of 30 and 20% of outflow totals. Another interesting piece of information on the energy front is that the European Commission is considering a draft bill that will classify lithium as a Category 1A toxin. And if the proposed wording goes through in the fourth quarter of this year, Europeans' electronic vehicle, the EV market, might be put into jeopardy. This is some news breaking that you're probably not going to hear on many other podcasts. And should the lithium carbonate and hydroxide be classified as a toxin, mining would still be legal. However, it would inevitably come with a string of risk management restrictions and protracted permitting procedures, all done by the state. It would be the EU in this case. And finally, a Goldman Sachs, so take that into account, analytical report issued last month forecasts that lithium prices would correct for the rest of the year and remain under pressure over the upcoming years amidst oversupply. And of course, this has really irked a lot of people that are looking at lithium from the bullish only perspective. Well, first up, this is from BNN Bloomberg. I'm just going to read the headline because I don't have access to the whole article, but the headline's most important. We expect interest rates to remain high and push gold into a correction. Bart Mielek, global head of commodity market strategies at TD Securities, joins BNN Bloomberg and discusses his outlook for commodities after the U.S. Fed's interest rate announcements today. So this was Wednesday. He said that gold has done its job of being a stable asset amid high inflation, but over time, if interest rates continue to rise, it may be in line for a correction. What he's not saying, and I have many times, is that in order for interest rates to really be meaningful to the price of gold, it's got to be positive rate of return, which if you have an 8.6 annual inflation rate, that means you've got to get a 9.6 yield in order to have a 1% real rate of return. And I don't think they're going that high. Could happen. I doubt it highly. Regardless, everyone is kind of taught now that the amount of little increase in the interest rates across the spectrum will be detrimental to the price of gold. Not true. Further, I lived through the 1970 through 80s bull market in gold and silver, and what I witnessed was as inflation got worse and worse, and the interest rates did start to rise, and gold ignored it and kept going because the inflation rate was greater than the interest rate until Paul Volcker came in and basically put the interest rates at about a 5% real rate of return. In other words, a 13% inflation with an 18% T-bond was a 5% real rate of return, and that did quash the gold market. However, there were some of us, such as myself, that were in error looking at that high an interest rate, not only what a great yield, especially on the United States-backed security, but also risk. The higher the interest rate, usually the higher the risk. This time, at this juncture, where we might see higher interest rates, and again, I doubt it'll be anything close to that, the market may see it differently than it did in 1980, meaning that they see it as I'm not willing to take that risk to get a return on the US dollar because I think the currency is going to be destroyed. That's, of course, not what happened in 1980. I was, I guess, way ahead of the game, being overstudied in inflations and hyperinflations and the end of the great inflations where the currency is destroyed. This time it looks like it's inevitable, but the dollar will be the last to fall. It will be sought after en masse across the world because most dollar-denominated debts require dollars to be paid back. So the dollar, as shown in the extra curve, will actually be one of the strongest things to be in until it isn't. And of course, the smartest money will be moving into the precious metals and other commodities, but primarily gold and silver, as the dollar continues to look like it's the best thing out there. And again, until it isn't. Once the confidence is lost, trust is gone, people don't want to hold dollars either on a short or a long-term basis. That's basically the end game. As I've said over the last month or two, I really believe that the run to gold has started, but it's a very light walk. Not many people are paying attention to it. This is from Bullion Vault on their gold news section, came out on the 10th of June. Russia's return set to boost central bank gold buying. Due to the current political and economic turmoil worldwide, central banks are expected to show only a modest increase in their gold buying following last year's rebound, according to leading analysts. And again, it'll walk, and then there'll be a brisk walk, and then it'll be a jog, and then a run and then, as I said, an all-out sprint. Of course, that's obviously a metaphor for how the run to gold will take place. It will be probably panic buying near the top. So gold, like all these markets, has moved up and down and up and down. What's interesting is that gold actually did its job on the release of the inflation numbers and moved up. That's what this article is all about from the Wall Street Journal. Gold prices rose Friday as May inflation data came to a new 4-decade high. Some silver news: the dollar could be rolling over, and that could give silver a boost. 2022 has not been kind to precious metals bulls, despite the big run earlier in the year. We've seen one of the largest silver routes in history, yet the U.S. dollar has been melting down since yesterday's Fed meeting. Well, this is very short term, and she's right, but longer term, I think we still have a long ways to go to the upside. Despite the positive development, silver can change directions on a dime. Agreed. In a merciless manner, agreed that we're like leaving quite a bit of room for error and thus keeping things small. Traders with high risk tolerance could consider a bull spread. I won't go into that, but basically she's bullish on a short-term basis. I'm a little more reserved. I'm not sure. I think we're going to have kind of a sideways market through the summer and probably catch a bid and do better in the fall. But anything can happen under these very trying times and these huge market volatilities throughout the entire spectrum of markets. And this one more negative article about silver price forecasts. Silver markets continue to face the same headwinds. You can read the article. Technically, it doesn't look that great, although I'm pretty proud of the fact that it's held pretty well near the 2150 level, which is what I put out both publicly and for the premium service some time ago. And so far, that's holding. Whether or not it will remain there or better remains to be determined. On a short-term basis, this is a delivery month, and at present, we have about 57,000 contracts remain open, and the registered stocks are at a recent low. It's been lower than this over the decades, but as far as the last couple of years, it's at 71 million ounces, and that is enough silver for around 15,000 contracts. And this has been put up on the web and talked about ad infinitum. I mean, this has been talked about over and over and over again. And the whole premise is, well, there's this many contracts that are open, and all you have to do is stand for delivery. And if you stand for delivery, it wipes out the silver supply. And all that's true in theory, but it will never happen, or close to never. Because, one, all the time, every time so far, the contracts roll over. In fact, sometimes even after final notice day, they roll some of them. Regardless, most of it goes from paper to paper. Now, if that stand for delivery were to take place, the exchange has already protected itself. They have a limit of 1,500 contracts, which is 1/10 the approximately 15,000 that are open right now, which is 7.5 million ounces of silver, which is 1/10 of the 71 million that's available in the registered category. And they can enforce that. Now, they have delivered beyond that limit sometimes. I learned that from Craig Hemke, and it's true. But that doesn't exempt that rule. It doesn't mean that if someone stood for delivery for the 70 million ounces that they would get it. They wouldn't. The exchange would come in. So it's 10 days to go. It'll be interesting to see. I think there will be a lot of physical delivered, and here's why. There's a huge arbitrage opportunity. If you can buy paper silver, which is backed by some physical, and take those 1,000-ounce bars and punch them into 1-ounce round or kilos bars or 100-ounce bars or whatever, the markups on retail is a huge spread. So you can buy silver very, very cheap, reform it, and sell it very, very expensively. And that's an opportunity to make fiat, lots of fiat, lots and lots of fiat. So I'm certain that there are some entities that are taking that on, but it would be probably too big a risk for, let's say, a startup to do it. By the time capital cost on buying a mint to produce commercial or retail product in silver is quite expensive. There's a lot of capital expense before you're able to convert those 1,000-ounce bars into wafers or rounds or medallions, kilo bars, whatever. Nonetheless, those that already have that ability are probably going to, double shifts or move as much product as they possibly can. And of course, the government mints primarily are way behind the power curve, having difficulty staying up with the demand, even though it's beyond belief as far as what the premiums are in government minted coins, particularly the Silver Eagle. And finally, for the PGM buffs out there, I've said to the premium members and also publicly that I'm very much more favorable to platinum than palladium, and that wasn't the case. I was very favorable to palladium over platinum and was correct. But I think the tables have swung, the pendulum has swung, and that platinum is probably the better play. So for those that pay attention to this market, flooding has halted 60% of platinum group metals output for the month, so it's only for a month. That's CB in Stillwater. It's a U.S. mine over in Montana. Very good one, by the way. And for those that follow my work and are willing to take a deep dive and do a little homework on their own, this is I left the best for last as far as I'm concerned. This is from Bloomberg. Hedge funds stand back to let Elliott do the battle with the London Metals Exchange. Paul Singer is famed as a tenacious competitor, even by dog standards at Wall Street. This week, Singer's Elliott Investment Management launched a $456 million legal claim against the LME. Many of his hedge fund rivals find themselves in an unfamiliar position. They're rooting for him to win. Talks about the market mayhem that took place in the nickel market and what I think most of you know, at least at a cursory level, what took place. Under UK law, judicial review must be initiated within 3 months of the actions, and that's the focus of the complaint. So you could go ahead and read this whole article. It should be easy to find based on the title I showed you. I think that's good homework for those that are interested in the difference between these paper paradigms and the reality of real commodities. So I'll leave it there. This is David Morgan of themorganreport.com with another weekly perspective. And as the tides get higher and higher and the uncertainty grows, stay calm, don't panic. Humans have gotten through worse conditions than we're currently seeing, but it will be interesting times ahead. My best to you all. I'll be back next week with another weekly perspective.